All right, what's going on, guys? This is Taylor checking in on Monday, October 2nd. Got ourselves a bit of a barroom brawl today. In the right corner, you have the QQQ and the tech stocks. Apple up 1, Amazon up 2.4. I'm sorry, Amazon's only up 1.4. You got Nvidia up 2.5, Meta up 1.2. And then pretty much anything that's not a big giant tech stock is down. RSP's down 1.4, energy's down 2, leaving the S&Ps down a brisk 0.5%. So guys, we can talk charts and all that fun stuff. But they wanted me to jump on here today to talk to talk a little bit about the account challenge that I'm doing over in the Mastery. So I know a lot of you are already part of the Mastery, the compounding growth mastery here at Simpler. And as far as the group account challenge, admittedly, a challenge might be the wrong word, because we don't have a set goal. We don't have a set, no deadlines where we've got to turn X amount into X amount in, 30 days, 60 days, 90 days. Rather, the goal is just, what I'm going to be doing now with the trade alerts is posting my position sizes along with the alerts. And I respect the fact, and I acknowledge the fact that everybody's got different account sizes. Smaller accounts, 6 figures, 7 figures. So the whole goal here with the Mastery Challenge is that everything's going to be based on percentages. The dollar value that I started to choose with, or that I chose to start with, is $10,000. Now, there might be some of you with a $5,000 account, a $2,500 account. There might be a few of you trading, bigger 6-figure accounts. Again, the key is percentages. The real key being there's a time and a place for more aggressive trading and bigger sizing. For those of y'all in the Mastery, you know my favorite trade, right, and my favorite time to really load up and get aggressive is when we have these bigger daily squeezes. All right, more specifically, in the S&Ps, the Qs, and the market itself has a bigger squeeze. For me, historically, that always sets me up for my best swing trading. Now, the reality of the squeeze is, as fun as they are and as powerful as they can be, if we take the S&P futures, in the last 5 months, there's been 1, 2, 3, and then 4 occasions where you had that big daily squeeze setting up. And again, for me, that's pretty much like my time to shine. I'm going to run my scans. I'm going to trade my A+ setups, right, everything that fits the bill on the big 3, but I can trade that with size. 70, 80% of the time, we're not getting these big, explosive, concentrated moves. Meaning that big squeeze opportunity where we can really load up on the calls or really load up on the puts, that happens maybe at best like once per month. If anything, maybe 5 or 6 times per year. So point being, when it comes to growing your own accounts and when it comes to growing the group account, everything's based on percentages. And the whole goal is we're aggressive when it's time to be aggressive. All right, there's going to be weeks, there's going to be days where you can move the ball forward by 10, 12, 15%. Take a couple trades, really size into them. You can make some really meaningful progress. Then there's a time, perfect example. We're in the Mastery right now. From a swing trading perspective, I want to get short. I'll show you the S&Ps here. Everything on my indicators tells us get short. Got daily sell signals. Got a 4-hour sell signal, 30-minute, 15-minute, 5-minute. Everything says get short. This is not the spot where I want to get short. If price is that far from the 21 EMA, it's not the spot where I can put 10, 12% of my account into some puts. That's 20% of the time. The other 80% of the time, you're kind of waiting around for those bigger trades. So as far as account growth, the only trade we did in the Mastery last week was a big iron condor. All right, not a sexy trade, not exciting. It's not gonna get your blood rate going. But if you position size appropriately, right, that one condor, if that hits your target, that trade might make you 1%. It's not a big squeeze. Right, you're not putting 15% of your account into a trade. But in the right market, while you're waiting for a bigger pitch, you're waiting for an aggressive trade, you're throwing on things like that with what I think is a baseline goal of about 2% per week. So for those of y'all doing this challenge with me, whether you have a 10K account, whether it's 100K, 100 million, if it's 100 million, I got some questions for you. But 2% per week, it adds up. Now, 2% per week on a $100,000 account sounds pretty nice. $2,000 per week at the beginning. All right, it only grows from there. 2% per week on $1 million account, obviously really sexy. I think we'd all like to sign up for that. 2% per week on, say, $5,000 or a $10,000 account, it ain't that sexy. Week 1, your goal is about $200. Most of us aren't jumping out of bed at the idea of making $200. Now, how can you make that $200? Well, in a good market, you're putting on bigger trades, you're getting more aggressive, and frankly, in a good market, you're going to blow that weekly 2% goal out of the water. In this current market, the way that I sized, so we got a condor that expires this Friday. Got our short puts down here at 41.95. We got the short calls up here at 4,400. With the way that I personally position size that trade, if I hit my 60, 70% of max profit, it's not quite 2%. So it's maybe 1 and change. But point being, that boring trade, it's a little contribution towards that baseline goal of 2%, which is not exciting at first, but you do that 1, 2, 3 years in a row, the 10K compounds into just about $200,000. That's the goal, though. There's a time and a place. So for those of you in the group right now, you'll notice we're not putting on big directional trades. Not putting on 5% risk, 10% risk. We're not buying calls. We're not buying puts. We've got a lame iron condor. Right now, as far as trying to grind out that weekly goal, that's kind of the trade that it calls for. We're not back here near the 21 in a big squeeze where we're buying puts and we're getting heavy. We're not in an uptrend, pulling back to a 21 EMA. We're kind of down here in no man's land, above big support and below big resistance. So I'm pretty excited, guys. The challenge will be, and the challenge has always been, the market will give you these periods of time where, May, June, and most of July is like a prime example. You've got trend, you've got momentum, like everything's working. So one of those markets where the fish are kind of jumping in the boat. I think the easier part of trading is recognizing that and taking advantage of it. All right. In my experience and what I've seen from a lot of traders, that's not the tough part. Like, yeah, if the market's going up every day, it's not the toughest thing to make a few bucks. The difficulty is being able to switch the game plan, the mentality, the aggressiveness almost overnight. And I think this year we've done a really good job of that just by listening to the indicators. We're playing it long, we're playing it long, we're playing it long. The morning of August 3rd, the indicators told us, stop playing it long. Stop buying calls. Stop looking for squeezes. Right? Stop selling put credit spreads. Whatever the heck you were doing back here that was working, because the signals have changed, it's probably not going to work anymore. So collectively, that's the the biggest part of our jobs. The game plan on Monday, right, the quote unquote easy trade on Monday, might completely change by Tuesday. So got to remain flexible, got to remain nimble, and then like I said, there's a time to go for it. And I think a big part of trading is you got to be able to step up to the plate when it's time to go for it. The other 70, 80% of the time, just trying to crank out that goal, right? Waiting for that big juicier pitch. So any questions on that, guys and gals, feel free to throw them on over. Otherwise, as far as this market goes, I did want to show you one thing. I can't help myself. So here's where we find ourselves. We are technically oversold based on most rules of thumb. We're technically oversold without a single signal to justify a move higher. This is why I kind of love this iron condor right now. The trade might not work, but I'm sitting here all day and I'm not in this rush to put on a new trade. I'm not making up a trade idea as I go. All right, well, we're a bit too oversold for me to want to get short. All right, we're a little bit too far from that 21 EMA. So let me go ahead and get long. 5-minute sell signal, 15-minute, 30-minute, 4-hour daily. That's probably not a great idea either. Just sometimes it's not going to be a big, high probability directional trade. That's kind of where I think we are for now. With that being said, the level I would have you watch here into the close would be Tuesday's low. Tuesday's low being, let's call it, $42.65. So I'm going to slap a $42.65 on here. All right, so here's what I'm seeing. And even though we're quote unquote oversold, it's a dangerous combination for the bulls. When the structure is broken to the point it's broken here, meaning we're under the 50, we're under the 21, the 21 is crossed through the 50. All right, momentum is busted. Pretty much when we have a sell signal, the only way the bulls can really take it higher is the short squeeze. Structure is not aligned for a push higher. Momentum is not aligned for a push higher. They've got to trap the shorts and they got to squeeze them out. It's kind of the only way they can actually take it higher. So notice how on Wednesday, which is that candle right there, on Wednesday they take out the Tuesday low. Right, they dump it beneath the lows. They rip it about $30 away from the 200 SMA. Imagine how many folks are getting short into that break of the low. Like, oh my God, we're taking out the low. We're going to the 200 SMA. They rope you in, right? They sell you the puts. By the time the market closed on Wednesday, we're already back above that Tuesday low. Now the bulls have got a little bit of a chance here to have set the trap. Take out the low, dump it, freak everybody out, get them into the puts, and then boom. Pull the rug out from underneath them. So day one looked promising. Day two looked pretty promising. A little bit of follow through. Day three, not too impressive. They came out hot and heavy and kind of walked it down into the close. Now today, here we are testing that Tuesday low. So any kind of potential bull trap they were working on, that's basically thrown out the window on a close under Tuesday's low. It's all the motions. All right. Anybody who got short back here, they're already feeling the pain by the time we close that day. They go to bed in pain. The following day, they're feeling a bit more pain. So now, for the first time in a while, the bulls have actually got the bears on their heels. All right, they got them backed into a little bit of a corner. That trap dynamic, rope in the shorts, squeeze them out. When the structure is so busted, that's their best chance of actually taking things higher. So for them to pretty much just drop the ball, and now we're threatening to close under that level, even though we're quote unquote oversold, that probably sees the S&Ps heading right down towards that 200 SMA. Selfishly, my hope was we'd set the trap, rally back towards the 21 EMA, and then we get short. Then we play for the flush down towards 4,200. I think the odds of getting that bigger shortable rally, they're pretty slim if we do close today under that Tuesday low. So if you're bearish, you're already short. Best case scenario for you is we close as far under 42.65 as possible. In most situations, I would put a knife in the bulls. If you are bullish, or you're like me, you're not really either, but you'd love to short it somewhere up here, then best case scenario is we close as far above that 42.65 as possible. But for those of you on the mastery, you can see why we're not putting on a bigger trade right now. Yeah, we could go lower. It's not my favorite spot to short it. Yeah, we could go higher, but the signals look like crap. We can force a trade, or you practice some patience and you wait for the bus. Always a bus coming. So Charles, good question. If all of the stars aligned, and the last time we really had that was April, May. And you might only get this once per year. But to me, what the stars aligning means is, here's the SPX. So mama market herself, April, May, June, you've got a weekly squeeze coiled up. Inside of it, there was a 3-day squeeze. Inside of that, there was a daily squeeze. When the S&P 500, right, and the Qs, the small caps, and the whole market is setting up for that big explosive move, like I mentioned, I think that's always going to be your best swing trading. Now, you've got as much wind at your back as possible. So my favorite trade in that kind of market, something like a Netflix daily squeeze. I've got the ultimate timing now. Back here in May, not only is Netflix the perfect setup, daily squeeze, daily buy signals, there was a weekly squeeze, like just a total squeeze fest. Not only was Netflix setting up for a high probability move higher, the entire market was. I've got my A+ setup with the entire market giving me a huge thumbs up. S&P say, yeah, Netflix, go for it. We give you our blessing. We can look for the same thing for a short, right? But to me, that's like the stars have aligned. I've got big squeezes in my stocks. I've got big squeezes in the indices, and they're all pointing towards the same direction. So, Charles, like a market like that, that's where I put on 10 to 12% risk per trade. Now, the thing with position sizing, guys, is, and I say this as someone who's gotten hurt by this before. we tend to get really caught up in the risk per trade. I'm going to risk 1% of my account. I'm going to risk 2%, 5%. The major thing you want to be most mindful of is your overall exposure. If you have the account size doesn't matter. If you take 2% per trade, so if you have a $10,000 account, that means every trade you're risking $200. You're not going to sit there and just lose $200, but the max risk would be about $200. That's not crazy, not overly aggressive. And if that trade blows up on your face, yeah, it's only going to get so bad. It's 2%. Now, if you have 3 open trades, I can't count 6 open trades. Now you have 2, 4, 6, 8, 10, 12% of your account. So it's a little bit to do with the size per trade, a lot more to do with the overall exposure. I say that to say, in a market where I think things are lining up to the point where, hey, I want to take a 10, 12% position size, I don't have 3 or 4 open. Meaning you're not going to find me going to bed with 50, 60% of my account in calls. So always be mindful of that. But yeah, when the stars have aligned, so to say, I'm looking for 10 to 12%. Aside from that, I'm kind of in the 2.5 to 5% neighborhood on average. It'll depend on the trade. Now, my Condor, for example, on my Condor, I'm risking about 7.5%. I did one contract in my $10,000 account. The max loss was like 750-ish bucks. Now, am I going to sit there and let that trade go to zero and just watch that 7% disappear? Definitely not. I've allocated about 7.5%, but now if I manage the trade appropriately, I should lose a lot less. That doesn't mean that I don't wake up tomorrow and the market is gapped down so much or gapped up so much that I'm not looking at a max loss. All right, that's always in the cards. The truth of the matter is, you trade long enough, it's going to happen to you. So one question I get is, okay, if we're willing to lose, 5% of our account, well then can I put on a trade with 10% and just use a 50% loss? To me, that's a little bit, it's playing with fire. In a perfect world, yeah, you put on a 10% position size. You take it off at a 50% loss. Yeah, you lost your 5%. God forbid you wake up to a huge asteroid. Yeah, you might be looking at that max loss. Don, time to short NVIDIA. The spot to watch NVIDIA, Don, I think is the hourly 200. Now, before I show you the hourly 200, and I know we've talked about this in here before, NVIDIA's had a momentum problem since June. The histogram peaked in June. They keep trying to go for the breakout. 1 breakout attempt, 2 attempts, 3 attempts. At no point have they shifted momentum above zero and kept it above zero. So for that reason alone, it's tough to see it as super bullish. Now as far as the short here, Don, you got a nice little intersection right here. The daily 50 lines up perfectly with the hourly 200. That doesn't mean the short works, but I think it's a pretty straightforward trade. Short it under resistance, daily 50, hourly 200. If it breaks above that level, I think you cover the short. So long as that doesn't happen in the form of a huge gap up against you, that trade shouldn't carry too much risk. And then guess what? If the market rolls over again, you could probably see NVIDIA back towards 400. So your risk looks a little something like this. Reward would look a little something like this. There's my target. There's my line in the sand. What makes for a good entry? When I'm getting long or short, closer to my line in the sand than I am to my target. You can see my difficulty when on the short the crap out of the S&Ps here. Where's my target? It's right down here. Same target as every other trader in the world right now. Where's my line in the sand? I mean, the 21 EMA is definitely one of them. But frankly, I think it's a short under the 50. So I'm really looking at a risk reward something like this. Reward, risk. I don't know of an options trade in the world where that's going to work. I'm going to make more on that flush than I'll lose on that rally. Now, if you know of the trade, please let me know. We rally for a bit, maybe 43.50-ish. The entire dynamic just changed. Risk, reward. So it makes it a tricky spot. Tricky spot. Yeah, Young. I do like to play the options on the ES and the NQ. I'm learning a little bit more about the margin requirements. I went to go do another trade in this account today, and they stopped me in my tracks. Something about I got to let my futures cash settle. But yeah, I do like that. I do like the futures. What time is the official close for option purposes on the ES? So Young, if the option expires that day, so for example, you buy a call on the ES that expires today. Don't quote me on this, but I believe that call is done when the futures close. So about an hour after the cash market. Coop, you could wait until it gets closer to 200 SMA though. Coop, do you mean there's a spot to potentially get long? No, yeah, absolutely. Yeah, if tomorrow morning we wake up at 42.15, yeah, I'm not thinking about getting short at that point. I'm thinking, all right, let everybody else get short, and then we'll try to play for a bounce. Then you look at it from the opposite perspective. If I get long right here, what's my risk? Well, I'm probably going to close the trade on a break of the 200. So there's my risk. If I catch a bounce back to the 21 EMA, there's my reward. So, Coop, I love that you said that. Right? Even in the context of a really ugly chart, it all comes down to timing. I think one of the worst possible trades that we could take this week would be getting short right above the 200. The indicators, they all say get short. The momentum histograms, the arrows, everything says get short. Doesn't mean it's a great short. It might be a better long, risk versus reward wise. So I am with you on that one, my friend. I am with you on that one. So Young, I see you saying that your problem was over trading. To me, the cure for that has been staring at spreadsheets like this for 10 minutes in the morning and then 10 minutes at night. Like right now, because I'm always looking to build up my own game. Where can I get better? Where can I add to my game? Not just for my own financial sake, but for those of y'all in the mastery. What are more things we can add to our repertoire while we wait for my favorite trade ever, that big squeeze. R and Condor in the group account and in my bigger account. I've got the same baseline goal in my bigger account, just 2.5% per week. Are there going to be weeks where I could probably go for 20? Yeah. But on average, in a $200,000-ish account, yeah, that 2% per week is going to get really meaningful. So Young, I say that to say, like, I'm sitting here today on my Condor, and I'm not having fun. Like, I'm not getting any excitement. Like, I don't feel like I'm trading today. I'm not trading today. And there's that weird voice in your head that says, hey, like, you're a trader. You should be trading. Why aren't you clicking buttons and, buying and selling? Yeah. Then the realization is if the market can just freaking close above 41.95 and below 4,400, I'm pretty close to that weekly goal. My human nature temptation is to want to trade like right now. Let me go find something to trade. There has to be something to do. And I can promise you, Young, there's going to be weeks where you probably don't want to leave the office. There's going to be markets where if you leave, it might be an expensive bathroom trip. Like things are just that good. And I love that kind of market so much. So for me, the struggle is, all right, well, we're not there. I can either force the issue or I can do the difficult thing, which is some days do nothing. Other days put on a boring condor and then just kind of let it work out. My problem is always, I'm right here. My all my goals and dreams and aspirations, they're up here. And I'm trying to get there like as quickly as possible. So when you got these big goals and you're trying to get there as quickly as possible, no part of your brain wants to hear, yeah, today we should probably do nothing. Like you go into an internal panic. Like, what do you mean do nothing? I've got to hit these goals like right now. One of those things where we overestimate what we can do in a month and grossly underestimate what we can do in a year. So for me, Young, just kind of looking at these things, that's, for me, it's really helpful. Very, very helpful. Young, my baseline monetary goal is just 2.5% per week on average. And what would that look like? If we print out my performance for every week of the year, it's not going to be 2%, 2%. Like it's not going to be this just steady 2% every week. There's going to be great markets. There might be 10, 15, 20% weeks. And like anybody else out there, guys, there's going to be rough weeks. Like you're going to go into a Friday night licking your wounds. You lost 2%. You lost 5%. Stuff really gets nasty. Maybe you lost a little bit more. All right. But on average, at the end of the year, can you be in that neighborhood? So when I don't see a bigger swing trade, I don't see a spot to, let's really get aggressive here. What do I got to do to grind that gold out this week? Is it a big condor? Is it sitting here waiting for a day trade? Is it whatever it is, we're looking for it. And I think the other important part of thinking in terms of percentages, everything will remain consistent. All things being relative. If you're starting off with a $10,000 account, you risk 2% per trade and the trade goes to zero. Losing the $200, it's only going to be so emotionally devastating. Now, if you have a $1 million account and you lose that 2%, that's $20,000. And now we start to equate that to real world things. That's actually one of the biggest mistakes I used to make. Every loss was tied to, well, shit, that was 2.5 months of rent. Now you've got that in the back of your mind on your next trade. Like, man, I hope this trade works. I got to make back that 2.5 months of rent. You think of a guy, John's level, 8-figure account, 2% is probably $200,000. So, begin with the end in mind. The goal for all of us should be, we're trading a John Carter size account one day. If we're not thinking in terms of percentages, mentally it's almost, I'd imagine, impossible. So from the beginning, think always in terms of, all right, I'm risking X% of my account. The trade worked, I just made X% on my account. Or the trade didn't work and I just lost, X% on my account. Versus I made 1,200, I lost 2,000. The dollars. Powernomics, the quant levels, yeah. And got a couple more minutes left here, guys. Did you want to see the weekly or the daily? Mi amigo. Or amiga. Weekly? All right, you got it. Projections, no. So weekly H2 is around 43.86 and weekly L2 is around 41.80. So guys, there's a good example of, and as we continue to do more of these condors, we could probably wait a little bit closer to the close. If you're going to do it on a Friday, then you're doing that based on the next week's projections. All right, those projections are based on the closing price. So the most accurate way to do it is you wait until 3:59 p.m. Eastern on Friday, 1 minute before the close. Then you take your projected levels and then you throw on the condor. I think we did it about a half hour before the close. The action into the close did change those levels. So we're short the 41.95 put. L2 is a little bit below that. On the call side, it works to our benefit. We're actually a decent amount above H2. Right, and again, it's not a squeeze. It's not a big hold on to your hat kind of moment in time. We're taking a couple of levels where, based on the last 62 weeks, there's a 92% chance we're going to close above that green line and below that red line. I like those kinds of odds as far as, all right, I'm not going to bet the ranch, but can I grind out 1.5% from that trade? And remember, right, that's the sexy part. Like, ooh, you telling me if I do this condor every week, 90 times out of 100, I'm probably going to cash out? That's what the odds would suggest. Your major focus as a trader should be, All right, well, how ugly does it get the other 8% of the time? Am I losing 2 times more than I stand to make? Am I losing 4 times more than I stand to make? Learning how to use, something like the Analyze tab, that can be helpful for position sizing as well. The way I figured out that I was comfortable with the 7.5% position size was I took the condor, I threw it into the Analyze tab, and then I could see, all right, well, if I wake up on Monday and we're down here at my short put, percentage-wise, how much am I down? And if I wake up Monday and we're blowing through my short call, percentage-wise, how much am I down? And I was comfortable with that. I liked the ratio. If it's a 92% of the time the trade's going to work, I like the paycheck. If it's the 8% of the time the trade doesn't work, I don't mind the loss. All right, but everything goes back to thinking as far as percentages. But all right, folks, I'll let you go there and let you get on with your Monday afternoon. Wherever you are in the world, I hope it's as beautiful as Massachusetts this time of year. But yeah, guys, I'll drop a link here in the chats for the mastery if any of y'all want to check that out. And then I would also suggest, because things are getting interesting here, come through on Wednesday morning. I do the pre-market preps in here Mondays and Wednesdays. It's a nice chance for us to get together before the open, get a little caffeine in the system, and prep for the day ahead. But all right, guys, before I let you go here, pop quiz. Let's see who was taking their notes. What is the key level for the SPX today? What is the level the bulls must defend? Ellen, you win. Ellen, you win a simpler trading sticker. That's the good news. The bad news is I've been promising simpler trading stickers for about 3 years. So when I finally work my way out of my my sticker debt, you are on the list. But all right, y'all have a good day. Thank you for your time.